that right there is a massive risk.
Let's get to the actual thesis. We've got to look at what isn't being talked about nearly enough. Two big, interconnected credit risks that are building up around private assets and the financing of this whole AI boom.
This number right here, this is the critical data point. We're talking about an $800 billion minimum funding gap for the AI infrastructure build-out. You know, private markets were supposed to fill this gap, but the data shows they're failing. And that right there is a massive risk.
You know, Mike Green from Simplify calls this volatility laundering, and it makes perfect sense when you look at the numbers. Private equity is out there claiming returns of plus 113% over 5 years. But their publicly traded levered equivalents, they're down 6%. This tells you the private returns are basically an illusion, totally unsupported by real-world performance. This is a house of cards, plain and simple.
And this brings us right to the first major structural problem, the financing of the entire AI boom itself. How is this all being paid for?
This entire structure is built on leverage and needs a continuous flow of capital. It's a classic vendor financing scheme, and let me tell you, it is incredibly fragile.
This setup perfectly mirrors the vendor financing schemes that led to the collapse of companies like Global Crossing back in the dot-com bust. You know what they say? History doesn't repeat, but it sure does rhyme.